Welcome back, guys. As I'm sure you know by now, my name is Martin Jones and this is P2 Corporate Reporting at the London School of Business and Finance. Interactive product, ACCA P2, Martin Jones. And I have appearing over my shoulder a slide here. I'm going to use my pen to press mini-me. There we go. I disappear into a corner and there over my shoulder appears the truth as I see it, which is that we are doing P2 Global Live Sessions. There's my name and there's my email. Please feel free to use it. And as you know, I like to restart from the beginning when I do these fellas. I think this will actually flick down straight away. No, it needs activating. Let me just activate this little program. There we go, that's activated it, and then we go. When I saw you on the first week, we did basic groups. We completed basic groups and went on to complex groups on the second session. Then we did foreign currency, which gave me just enough time to start cash flow statements, which I finished yesterday evening by doing the fabulous question Ducky. Ducky has the complementary question Squire, which you see over there as a homework question. That was yesterday evening. Current issues was where we finished yesterday evening. And today we move on to performance reporting and provisions. And it's 2 chapters this evening, 2 really lovely chapters. You're going to have a great time, dare I say. It's classic corporate reporting. Let's go, guys. So I'm going to ask you to turn to your class notes. Okay, there we go. There's the class notes. Oh, bit of a strange page to end up on. There it is there. There's my email. There we go. I'm not quite sure why I'm going to the first page to show you that this is my class notes. But there you go. It is my class notes. And we're going to go to chapter 6 with, you know, the critical subject of revenue, which, as I promised yesterday evening, is the top tip for question 4. So here we go. I've got a blank journal. Let's go for it, guys. So actually, can I do this? Actually bring you to the page 109. I don't know if this program's okay at doing this. It's a bit of a, I remember this program has that drunkenness thing where it zips through the pages as we go down, and you get the sort of drunkenness behind you. Page 105 is about right, isn't it? Let's go down for there. There we go. Oi, there you go. Well, that's good. This program's very stable tonight. Let me introduce you to my world so you have the feeling for my world. I am now in Studio 4. I've got the chat to the left, which those of you who joined me for the mentoring session will know very well. It doesn't seem to be auto winding down, perhaps because I was noodling with it earlier. So let me just see if I can get that to wind down. Oh, great, I can see lots of highs, that's good. So you're all back again, nice to see you guys. If I don't see a comment, guys, well, how can you get through to me? You can't exactly bang on my screen, can you? I'll try and keep scrolling down because the auto scroll seems to have been turned off by me, you know, winding backwards and forwards on the auto system. But let me tell you about my world. There's my screen in front of you that I'm going to write on. I've got my paper. I've got 4, 5 lights in this studio. I've got white walls around me, but what I don't have is I don't have a feed for myself. So actually there's a mini-me sitting on the camera above the camera. There's a little screen there, a little mini-me over there, but I don't have any idea of exactly how I'm coming to you live because that's the way it works in Studio 4. So what I can't see, well, I'm a bit of a weather girl, what I can't see is what really is over my shoulder. I'm just sort of imagining that above there is performance reporting. And performance reporting starts with performance reports. Perfectly reasonable, that, isn't it? Performance reporting starts with the subject of performance reports. And there are 2 performance reports, as you know. Let's go. Performance reports. The are two. There is the P&L and the OCI. And together they create what is called the SPLOCI, the Statement of Profit or Loss and Other Comprehensive Income. The P&L is profit or loss, and the OCI is other comprehensive income. But actually it hardly matters what these abbreviations stand for, because you will only be using the abbreviations when communicating with the markers. You'll only be using the phrase P&L and OCI and not the full. How does corporate reporting work in this area? With limited logic, the way corporate reporting works in this area is corporate reporting defines 5 items that go through the OCI, and by default everything else goes in the P&L. Five and 5 only go through the OCI, and they are given the mnemonic heaps. The heaps in the bottom of the SPLOCI in a big heap. Hedging. Foreign exchange on sub. Actuarial. Remeasurement. PPE, revaluation, and strategic equity. And that mnemonic is just for learning. At this stage, just for learning. One of those you've done already. It was in chapter 3. And of course, therefore, you are expected to know what a foreign exchange gain on a sub is, because we did it in the fabulous question, Kenya, where the subsidiary is Malawi. And we put the gain through the OCI and into the OCE, as I was discussing with Pinky just a moment ago in the mentoring session. But what you're not required to know at this stage is what hedging gains are, what actuarial measurement means, what a PP revaluation, and what strategic equity, because we haven't done any of these yet. But when we do them, we'll be referring to the OCI, and I'll be referring back to heaps. So at the moment, we're just learning the mnemonic and the mnemonic only. PP revaluation, you've guessed, is on tangible fixed assets, to use its old name, and pops up again in chapter 8. So we'll see that again in chapter 8. Actuarial remeasurement is related to actuaries, who are professionals in pensions accounting, and we see that again in chapter 10. And the top and the bottom fella are to do with financial instruments, and we see those in chapter 12. So we're going to see 4 of these 5 again over the next few evenings. The first one that we'll see actually is not tonight, but next time I see you on Thursday next week, we'll be doing PPE revaluation. Okay, that's it. That is all there is to this subject matter. Well, kind of. Maybe I should say this out loud. I don't want to get over technical, but it's coming out this way. PP revaluation sits in an IFRS, and as it goes, the IFRS is IAS 16. And IAS 16 tells us that PP revaluations goes into the OCI. So it does. But the way corporate reporting works is anything that goes in the OCI, the IFRS will tell us, but anywhere the IFRS is silent, the thing defaults into the P&L. So the IFRS on revenue tells us nothing about revenue, so it defaults into the P&L. The IFRS on depreciation tells us nothing about depreciation, so it defaults into the P&L. Everything goes in the P&L except those 5. So they are the exception to the rule. Everything goes in the P&L except those 5. And the examiner describes this philosophy rather elegantly, rather memorably, as being a dumping ground. He describes the OCI as being a dumping ground where we dump those 5 in a heap. Okay, good. Enough said. That's it, you're finished. And that's what this evening's experience is going to be like. Do a bit, then it's done. Do a bit, then it's done. Do a bit, then it's done. And it's lots of learning rules. Starting with the next batch of rules, prior period adjustment. Otherwise known as PPA. Just trying to get it a bit tighter than that. This means restatement of comparatives. Restatement of comparatives is required when there is either 1 or 2, and it's error or change of accounting policy. There we go. And again, we're just learning that, but I better talk you through it a little bit. By far the easiest and by far the most useful is error. Let me see if I can get you to take baby steps into this quite techie subject. Just see if I can also make sure I don't burn myself, because this is very hot tea. Maybe a bit too hot to drink just at the moment. I'll let that cool. Is that off camera shot? I'm really supposed to keep my drinks off camera shot. Really shouldn't be letting you all look so. Yeah, I'll get that off camera. There we go. So, should we start with the word comparatives? So you've got your words on the left-hand side, if I said that correctly. Yes, the left-hand side, revenue, cost of sales, admin, distribution, tax, all the way down there. So there's your, your P&L narrative, and then here's your current numbers here. So here's your current numbers down there. And on the right-hand side, next to the current figures for comparability, are the comparables, and they're last year's figures set next to this year's figures for comparison. So the comparatives sit next to the current figures. And it's those comparatives that we're talking about. And what we're imagining is that we're doing this year's current figures, and we're partway through this year's current figures, and we're dusting off the dust in last year's figures, and we discover an error in last year's FS. Now, it's too late to correct that error in last year's FS. They went to the shareholders a year ago, so they're gone. There's nothing you can do about that. But on the other hand, that information in last year's FS is about to be copied into the comparative column for the current year. And obviously, if there's an error in those FS, you have to adjust the FS before you do the process of copying. And that process of adjusting the prior period figures is called prior period adjustment. Seems perfectly reasonable, doesn't it? There was an error in last year's FS, so you adjust them before you use them as comparatives. Fair enough. But it's not the only circumstance where you would get an adjustment of last year's FS. The other circumstance is a change of accounting policy, which generally speaking is completely irrelevant, but it just so happens that this winter, December 2015, it's particularly hot because there's a new IFRS on revenue. For example, upon a change in revenue recognition, under the adoption of the new IFRS. Ooh, there's a new IFRS on revenue recognition. That sounds interesting. I want to know more about that. Good point. Let's rule off under prior period adjustment and get into what is definitely the most important component of this evening's lecture, which is revenue recognition. I'm going to do this one to death, so let's do this one to death. So, revenue. Probably once we get into 2017, you won't be required to know the old outgoing IFRS. I'm guessing, but I really think that for winter 2015 and probably for summer 2016, you'll still be expected to know about the old outgoing IFRS. So what I'm going to do is I'm going to give you a little intro for the old outgoing IFRS and then talk to you mostly about the new incoming IFRS. So, revenue. There is a new standard. And then, rather strangely, I'm going to go to the old standard. Am I squeezing myself up a bit there? I feel like I am. Do you mind if I just get rid of that? It's slightly fussy, I know, but I'm feeling a bit fussy, so let's fuss. The old standard number doesn't matter, but it was IS 18. And because this is so hot for December 2015, you'll probably find yourself remembering IS 18. The old IFRS had at and over, but little else. Whoa, that's a powerful sentence in its own right. What do we mean by at and over? Well, the old standard was entirely intuitive, and it recognised sales at a point in time, at that point in time, and it recognised sales over a period, over the period. So the two classic examples of at and over are beep. Sainsbury's is next door. It's actually the head office next door, as I often say, but just downstairs at the bottom of the head office, which is a massive building, there's a little Sainsbury's Metro, basically, a little store down there. And I just bought myself some water there as it goes. This really is purchased from Sainsbury's there, and there's the barcode, you can see it. And of course, when the water's empty now, but when I beeped it, beep, Sainsbury's made a sale. And what model would they use for recognising the sale? They'd use the at model. They would have recognised the sale at the point of the beep. The beep is the sound that the computers make when they recognise a sale. Of course, the beep is for me to recognise my purchase, but it's also for them to recognise their sale. So Sainsbury's have an at model of revenue recognition. But as it goes, Sainsbury's also have a bank. It's a very small part of their business, but they have a subsidiary which does banking. And I don't borrow from Sainsbury's Bank, but some people do. And of course, the interest cost would accrue over the period. over the period of a month, over the period of a year. So interest expenses accrue over the period, but of course we should be looking at this from the Sainsbury's perspective, and their revenue would be recognised over the period. Their interest income revenue would be recognised over the period. So there's the two classics for the old standard. It had the at model, boop, when you felt that the revenue was at, and it had the over model when you felt that the revenue should be recognised over the period. But it had, as you can see, little else, which meant that it was entirely up to you. There was the at model and there was the over model, but you could use it whenever you felt like it. There was no guidance, no detail. There was little else apart from at and over. So it kind of worked because it was intuitive, but it didn't work because, you know, with revenue recognition that was shades of grey, some guys would do at and some guys would do over, and that led to inconsistency. The old IFRS had at and over, but little else. This led to inconsistency. And the IASB basically decided that they quite liked the old at and over model, so they decided to keep it. And the new standard is called IFRS 15. You don't need the IFRS number, but you'll probably find that you remember it. The new IFRS retains at and over, but adds substantial guidance, including the 5 steps. Which I introduced to you last night, but only by way of introduction to COPAR. I now talk about it in more detail. As I said yesterday evening, a good way of seeing the 5 steps is the 4 steps up to revenue recognition. Whereas previously you just launch into revenue recognition, now there are 4 steps to get to before you can do revenue recognition. And by making everyone sit down and really think about their revenue, the IASB are hoping to improve consistency in revenue recognition. So the 4 pre-steps are contract, obligations, price, and allocation. There is an enormous amount in the IFRS about each of these. I mean, there really is. I'm trying to remember how many pages it is on each. I can't remember. I was looking at the IFRS only a couple of weeks ago, but I can't keep everything in my head. I think we're talking of the region of 2 to 5 pages of, you know, I don't know if you've ever seen an IFRS, but it's like Bible paper. It's that really thin paper that you hold up to the light and you can almost see through. Do you know the Bible paper I mean? And the writing's really, really small. It's hard on my eyes, actually, especially as I do tend to read it in bed, which is tragic, isn't it? So the number of words written about each of these is huge. You know, COPAR is a massive thing. It's a massive thing. And actually, if I'm honest, that's just the COPAR within the IFRS. And the IFRS comes with these extra appendices, like basis of conclusion and illustrative examples and all sorts of stuff. So, you know, I'm not exaggerating when I'm saying that, you know, there's probably of the order of 50 pages just on C and 50 pages just on O. Honestly, that's the sort of volume we're talking about. So I'm certainly not going to give you 50 pages of nonsense over the next 2 minutes. But what I am going to do is give you more than I gave you last night. What you do first is quite natural. I feel like you and I working together rather than you selling to me and me buying from you. I just feel like you and I should work together. So let's work together, and we're going to have a contract with that fella just beyond the screen, okay? Just sticking my hand out the screen to illustrate it. So just beyond the screen, we've got that fella, and you and I are working together to sell to him. We'll have it a him. So that him over there, that him over there is over there. And we are in the IFRS, we are called the entity, which is a bit dull. So we are the guys supplying our customer. The customer is called the customer, which is good, isn't it? And we're the supplier supplying our customer, and we're called the entity. And the first thing we do is we look at our contract to see if we have a deal with the customer. And if we don't have a deal, you don't do any revenue recognition. That's the basic idea. So to have a contract, you only need to have an agreement between us. And it only needs to be a contract in the sense that it is a contract within the culture of the country that you're talking about. So the meaning of contract would change from country to country, and it depends upon the culture within the country. And if it is considered to create obligations upon us and upon him in that country, then it's a contract and you start revenue recognition. But that's not really what I want to talk about. I want to talk about the OPA in between. The OPA is where the action is, and that's to do with a fella called unbundling. You see, it is very common for two things to be sold together in one contract. And can you see the critical S at the end there? Is that going to work? Oh yeah, that comes out quite nice, doesn't it? Can you see that critical S at the end of obligations? It's quite common for two things to be sold together. And there are plenty of examples of this, and I don't want to give you too much of a complicated one. I did this one recently, and it seemed to work for me, so we'll stick with it. You might have come across this kind of deal before. You and I work in retail, but what we sell is cars. And there's a customer just over there that's walking through the door, and what he wants is he wants a brand new car. But what we have is a good deal for him where we give him a brand new car and 3 years of free insurance for the grand sum of $15,000. So what he's going to do is he's going to pay one price for two obligations. He gives us the $15,000 and we have the obligation to deliver a car and 3 years of insurance. And we sell the combined product for one price. And there is a name for this marketing technique, which is very common in the industry I was just describing there, which is car retail. The name of this cute deal that we do, the guy, is called bundling. When you take two products together, add them together and sell them for one price, it's called bundling. But once a transaction is bundled by the marketeers, it then has to be unbundled by the accountants, you and I. So you and I are going to take this bundled transaction and break it down into its component parts. And we're going to do this process of unbundling in a formal way through the OPA. So this fella here is unbundling. And it is highly formalized in IFRS 15, whereas there was literally absolutely no guidance under the old IS 18. There was no guidance at all on unbundling under IS 18, so unbundling was a horrendous area of inconsistency and, let's be honest, creative accounting as well. So the ISB liked the idea of, keeping at and over and keeping unbundling, but what they wanted to do is make sure unbundling had some sort of formula to it, and there it is, we're partway through. So what we have at our stage at the moment is we have the two things that have been joined together and sold for one price. Can you see price up there says price? There's one price but there's two obligations. What we then do is we then allocate the one price to the two obligations and then break the contract down. And there's all sorts of different ways of doing this, but I think I will give you an example of one of the simplest. What we might do is we might go out into the market and see how much the 3 years of insurance would be if sold individually. So the 3 years of insurance would be $300 per annum. $300, $300, $300 per annum. $900. Remember, the total is $15,000. So if the insurance is $900, then $14,100 would be the car. So what we'd have done is taken the $15,000, broken it down into its component parts. We have got a figure of $14,100 for the car and $900 for the insurance. And this works particularly well within COPAR because the revenue recognition would be different for each. Of course, we would recognise the car revenue of $14,100 at the point that we delivered the car to the customer, and we would recognise the insurance over the 3 years. It would be $300 per annum, but it would also be 300 divided by 12 per month. It would be 300 divided by 365 per day. It would be over. It would be roughly like sort of 90p a day, wouldn't it? Would be the revenue that we'd be recognising. So that's a really lovely example. I'm very pleased I used that example. There's lots of them actually, and that seemed to work particularly well. Can I just take away the colour and reinforce it? No, that doesn't seem to be quite working. Let's give myself that back because I'm very happy with the pink. Is that good? Yes. What I want to do is, I guess, put in this yellow here, put in this yellow here, and then take it back out again. So let's do that again. The unbundling is do-cha, do-cha, do-cha. Oh, the rubber's not working. Why's that? Are you working? Sort of. Sort of. It's sort of removing bits I don't want to. Sort of. But I do want to do this again, so let's do it again. So, the COPAR model has got 5 things, but a really good way of seeing it is it's 4 steps on the way to revenue recognition. 4 steps on the way to revenue recognition. The first one, you're just checking if there's got a contract, and it's not a particularly big deal. But what is a big deal is the 3 in between. The 3 in between are doing this thing called unbundling. It is quite common for 2 things to be brought together and sold for one price. And the process of breaking this down into 2 separate components is fraught with risk. You know, one person could look at this one way, another person look at it another way. We don't want that inconsistency. We want everyone doing the same thing. So what we have is we have an OPA model in the middle of COPAR. What we do is, first of all, identify the separate obligations that we are supplying stuff to our customer. We identify the 2 obligations. Then we identify the total price for the 2 obligations, and then we allocate the price between the 2 obligations. And that is the middle component of COPAR, and is really what COPAR is about. COPAR is really about the centre section and unbundling. Cool, eh? Overlap with P7, beautiful. Definitely an overlap with P7, says Swishy. Cool, absolutely. It's probably actually slightly more advanced than is required at P7, but she's a very good examiner, is Lisa Weaver, very good. Acquisition phone and user contract, exactly right. So I wasn't going to use that example because it is a little bit more complicated. But these guys, Vodafone, yes, this is an Apple phone, but I was sold this Apple phone by Vodafone. They sold me a phone at a point in time and a contract over a period for one combined price. And what they did to me is described as bundling. What they did to their own dual products is described as bundling, but what the accountants in the background have to do is unbundling. And I've looked at Vodafone's FS, and they have currently literally 2 pages talking about their policy on unbundling within revenue recognition. It's really sophisticated. And what, as far as I can work out, Vodafone try to do is they try to be as honest as they possibly can. Now, Vodafone are working in the United Kingdom. They're quoted on the London Stock Exchange, and the London Stock Exchange hasn't adopted IFRS 15 yet. So Vodafone is still using old IAS 18 and seem to me to be making a good job of it. But once they have IFRS 15, they're going to find what they do much easier to do, because IFRS 15 really works for anyone that is trying to be honest, because it just creates a framework around which you can naturally be honest about your revenue recognition. So for any honest accountant, IFRS 15 is a great thing. For any creative accountant, for any manipulator, it's terrible news, because everything's locked down and it's much less easy to manipulate your revenue. Fantastic. So there we go. Really nice. I'm very, very happy with that. And we still haven't finished. No, not by a long way. Actually, COPAR is the easiest of the 2 main blocks of knowledge within the new standard. Oh, that's lovely, that's lovely. A cup of tea is lovely. The other one is NowCAS, and NowCAS is a little harder. Let's have a go at NowCAS. The standard has, 2 models, at and over. There you go, guys. I thought you might enjoy some silence. I just let the radio waves just emanate between you and me without the need for any voice. But now there is a need. What is it I'm talking about? Look again up under the old model. Do you remember me saying to you that under the old model there was at and over, but there was no guidance around it? So even if your revenue was obviously at, you could adopt over and creative account and mess about with revenue recognition. If your revenue was over, you could adopt at. You might have a bit of a battle with your auditors about this, but your auditors wouldn't have a proper IFRS to build from to criticise your creative accounting. So creative accounting in the world of at and over was a big problem. The way that the ISB have now solved this is they say you can do over if you're this, this, or this. You must do over if you're this, this, or this. But if you're not, you're at. So that's what I mean by the default revenue recognition. There's no definition of what at revenue recognition is. At revenue recognition is just the model that is used if over doesn't apply. So when does over apply? Over applies if NowCAS. NowCAS. If the revenue is no alternative use. If the revenue is customer controlled asset. if the revenue is simultaneous. And you can see that this mnemonic, this component of IFRS 15 is harder than COPAR, isn't it? So we'll have a couple of minutes on this. The now is the really hard one. So now we will start on the S. We're going to do these in reverse order. We're going to do S and then CCA and then now. Last is now. Here we go with S. Simultaneous. This applies if the customer consumption is simultaneous with supplier, there we go, supplier delivery. And yesterday I promised a bit of Ed Sheeran, and now I'll have it. The idea that speaks clearest to me is a pop concert. I think it's best if you have a pop concert that straddles midnight. So Ed Sheeran comes on quite late, actually, in the evening at 10 o'clock, and he's going to play for 3 hours. He's going to play between 10 and 11, between 11 and midnight, and then between midnight and 1. And it just so happens that that evening that he comes on to supply to you is the very evening of his year end. So the revenue recognition would be recognised over the 3 hours, which happens to fall 2/3 in the earlier year and 1/3 in the later year. So the revenue that he would make from that concert, the cash would all be received up front, of course, but the revenue recognition would be 2/3 in the earlier year and 1/3 in the later year, because the revenue recognition would be over. But why over? I think it's obvious, isn't it? Every note that Ed sings to you in the audience, you feel like it's to you personally. Every note that he sings to you in the audience, you consume instantly, and then it's gone. And then he sings you another note, and you hear it, and it's gone. And it's this idea of, he sings and you hear, that just works so well for me as the simultaneous model. If you want to get a little bit more dull, then, yes, it works for dentistry as well. It would be slightly weird if you were having your teeth done for half an hour straddling midnight, but if you were having your teeth done for half an hour straddling midnight and you paid $100 for the operation, then it would be $50 for before the year end and $50 for after the year end, if that midnight happened to be the year end. It's the same idea. And it also applies for, this one is slightly harder, but some students seem to like this one. I don't know quite why, but they do. But there you go. Gym membership, some students seem to like that. The idea of gym membership is a bit harder though, because what you have to imagine, what you don't have to imagine, it's true, is what you have to know is that I am a member of a gym down in Monument, which is over in that direction. But actually I am consuming the gym membership now. I'm not at the gym. No. What we're suggesting here is that the service that the gym provides is not the gym when I use the gym, but the availability of the gym. The gym was available to me this morning and I didn't use it. It was available to me this afternoon and I didn't use it. And it's available to me now and I'm still not using it, but it is available to me and I am consuming. And for every second that gym is open, I am consuming its availability. So gym membership as well is also over. But like I say, I find gym membership a bit nebulous, and I find a pop concert just much easier to go with. Football, the same thing, football match over a period, MBA course in education, and so on. Simultaneous, I think, is quite easy. The next one is a customer-controlled asset. Again, I think this one's quite easy, to be frank. This applies if the customer controls the asset upon which the supplier works, I think is the phrase I will use. And the example I give here is slightly more prosaic, but it is the example that the examiner himself used in one of the questions he examined recently. It's railway construction. No, it's not railway construction. Sorry, guys. It's not. It's railway maintenance. My apologies. It's railway maintenance. Sorry about that. So, railway maintenance. So, what we're asked to imagine in a question called Verge is that we are a railway construction business, but we also do railway maintenance. And there is a railway that already exists in Wales, shall we have it. It's there, it is working, but it needs maintenance. And we are asked over a period of 6 months to get the railway in Wales back up, healthy, strong and working. But at any time, the Welsh Railway Authority can tell us to naff off, get off my railway, because they continue to control the asset, the railway, and that's it. So if customer controlled asset applies, then you do revenue recognition over the period. So for example, if you had a railway maintenance contract which was for $600,000 for 6 months, then you'd recognise that revenue over the period, $100,000 for each of those months of railway maintenance. That's quite another easy one. The one that's hard is now, because there are two components, neither of which are easy. It is no alternative use. This applies if the asset made cannot be sold to anyone else, and the supplier has the right to be paid for work to date. And of course what I'm going to try and do is I'm going to try and give you an example, and the example is going to be in the construction industry. But old construction cost accounting, which has disappeared now and come into IFRS 15, old construction cost accounting was under IS 11, and crazy old IS 11, all it said as to what a construction contract was it was a contract involving construction. That really is what it said. Not a great deal.
was what the IFRS said. So you could use construction contract accounting without any thought whatsoever. If you just felt that you were in some way involved in construction, then you could just use construction contract accounting. And you might remember construction cost accounting had lots of percentages flying around, and what it was using was the over model. So you'd recognise the revenue over the period. So if you were, if you were 60% of the way through the contract, and you'd done 60% of the work over the first 6 months before the year end, and you'd recognise 60% of the revenue. So it was a form of over revenue recognition. So old construction contract accounting still exists, but it's just slipped into over revenue recognition. It still exists, and the construction cost accounting, in terms of the number bashing, is identical to how it used to be. But the problem with old construction contract accounting is there was no rigour as to when it could be applied. You could just basically do it any time you felt like it. The actual numbers haven't changed under IFRS 15, but the applicability has been locked down by this story here. And, I think it's quite challenging because, I'm just going to be completely honest with you. I've put a deposit down on a flat in South London. I've put £2,000 down on a flat in South London, and the flat hasn't been built yet. It is in the process of construction. I'm buying it from a guy called Imran and his company, and they are building it quite close to my flat. They're a small firm of builders in South London, and they build a block of flats every couple of years, and the block of flats is always quite small, and this one's 27 flats, and I'm buying one of those 27 flats, and hopefully it'll be me. I have put a deposit down, but the UK law is a bit dodgy, so, to be quite frank with you, I don't really have, I am in an awkward position because of the way British law works, but fingers crossed, he will sell that flat to me. The price is 360,000, and I've put £2,000 down, so I owe him 358. When he finishes the flat, he has the obligation to deliver it to me, and I have the obligation to deliver him another 358. But the point I'm getting to is this: he is constructing that flat. It really is very close to where I live, so I've cycled down to the construction site frequently, and it just looks exactly like you imagine a construction site looks like. It's got loads of guys with yellow hats on and diggers and physical stuff going on. It's everything shades of grey and concrete and iron. It's just exactly what you'd imagine a construction site to look like, but Imran can't use the construction contract accounting under IFRS 15 because, of course, he can sell the flat to anyone. Have a look at this. It says that you can only use the no alternative use criteria if the asset cannot be sold to anyone else. What is the asset created by the construction that Imran is doing? He's creating 27 flats. That one flat that he's going to sell to me, he could sell to anyone. It's South London, it's a flat. Of course it will go. Obviously he can sell to anyone. I mean, he could, probably sell the flat for 360 grand to anyone. But if he reduced the price just a little bit, he could really could sell it to anyone. So there's no way that, even though he has a construction contract under the old eyes of IAS 11, under the old rules of IAS 11, he has a construction contract. He wouldn't be able to do it anymore under IFRS 15 because he fails the first test. So what would be an example of one that would fulfill the test? Well, you have to build something very specific to one person, and that one person is the only person you can sell for. I seem to be going for an airport in Russia just at the moment. So building an airport for the airport authority in the UK is slightly dodgy, because maybe if you built an airport for the airport authority in the UK and they said no, you could sell that airport to the French airport authority. It wouldn't surprise me if it is legal for the French authorities to own UK airports. That wouldn't surprise me. That's the kind of thing that would happen in the European Union. So, what we want is a country where only the Russians can own a Russian airport, and I think that probably would apply in Russia. So it has to be quite a long story, you see. E.g., build an airport for an authority
that is the only entity allowed to own airports in that country. Well, that would fill the first criteria in now. That would fulfill the asset cannot be sold to anyone else. But look at this shocking word that exists in the middle of the criteria. And the supplier has the right to be paid for work to date. It's this work to date that then must be slotted in. So I have to put in an and. And the supplier has the right to be paid for work to date. Wow. Look at that. Look at that example over my shoulder. How many lines is that? 1, 2, 3, 4, 5. And in order for the no alternative use to apply, you need much, much more rigour. I described the second one as a pay-as-you-go, and the other one is the no alternative use. So for no alternative use, you can't sell it to anyone else. You have no alternative use, but you also have pay-as-you-go. If either criteria is missing, you need the and. If either criteria is missing, then you can't use no alternative use, and the construction contract will be recognised at the point it's delivered, and the control is transferred to the Russian authorities. So if I just play around with the bottom here, the entity build an airport for an authority. That is the only entity allowed to own airports in the country, but the supplier does not have the right to be paid for work to date. If that was the case, if I changed it where but the supplier does not have the right to work to date, then you couldn't use the no alternative use model. You wouldn't be allowed to recognise the revenue over the period, and you would be obliged to use the at model, and the airport would be recognised not over the period of building it, but at the point it was delivered to the Russian Airport Authority, and therefore would be later revenue recognition. Oh, it's quite hard, isn't it? So now that's the one to go for. So we do have now CAS, S is okay, CCA is okay, but now is the challenging one. Troy is thinking this would be rare. It would be commonplace. It'd be commonplace. So it would be very, very unusual for a builder to agree to build a contract for the Russian Airport Authority without building into the contract the fact that they have the right to be paid to work for date. Because, you know, if you go to Russia and you build them half an airport and then they tell you to naff off, you're going to feel pretty silly that you didn't put in a pay-as-you-go contract within that contract. So it would be commonplace. It would be commonplace. You can't see many now situations occurring. Well, there's certainly not just construction, is it? But it's specialist construction. But do you know where it would work really well? You probably haven't thought this through, but it's probably actually because it's not construction contract accounting. It's now. There are places that I think it works really nicely. So you and I are going to make a movie for the BBC. And the BBC is then going to show it to the public on their channel, BBC One. And the movie that we're going to make is actually a nature programme, and it is on the life of Bengali tigers up in the hills in Bengal. It's going to take us 2 years to make this programme, which is 1 hour long. And what we build in there is that the BBC have to pay us for work to date if they tell us to naff off at any point, which they might. They might change their mind about whether they want this Bengali tiger programme. But so what we do is we build in, if you tell us to naff off halfway through, then you pay our costs to date. Okay, so that's what we do, because we're not daft. We realise we're dealing with the BBC and they could tell us to naff off at any time.
So we build in the pay-as-you-go contract, and then, but what we also do is we're going to make a TV programme on Bengali tigers for the BBC. And do you know what? No one else in the entire world is interested in Bengali tigers. We can't take it to ITV. They're like, don't be ridiculous. I don't want Bengali tigers. We can't take it to Japanese television because it's in English. You know, we can't take it to the American television people because the voices are all... Exactly. So this product that we're making for the BBC can only be sold to the BBC because it's specifically for the BBC. And therefore, first of all, we have no alternative use. We can't sell the bit of television to someone else. And secondly, we have pay-as-you-go because that's what we've written it in. So there you go. Making TV for the BBC would fulfill no alternative use, and the revenue would be recognised over the period of building the programme. You see? Quite cute, isn't it? So I actually quite like it. I can tell you guys are feeling a little bit negative towards it, but I think it's good. Don't forget what we're trying to do here is we're trying to stop people from just using the over model anytime they feel like it, just because they're building something. You know, my son builds a few little blocks and he sticks them one on top of each other. He's not even selling to anyone. And he says, do you know what, I feel like doing construction contract accounting because I feel like it. And under IS 18, you could just do construction contract under IS 18 and IS 11. You could just do construction contract accounting anytime you felt like it, just because you did. And, you know, it could involve construction, as in, you know, building something. It could be a bit of landscape gardening. It could be anything. And really, they should have been doing at. But what they're trying to do is they're trying to drag their revenue forward by getting a bit of over. So, and that was, you know, commonplace, is commonplace still under IS 18 and IS 11. But now we're like, ooh, no. You can only have your over revenue recognition if you've got this kind of thing. Over revenue recognition does feel right in the Bengali tiger story. It does feel right in the story of making an airport from an airport authority. But making flats in South London is just like making lollipops to sell in South London. You know, they can be sold to anyone. And making flats in South London might be construction, as in it's building something, but it isn't over. Those flats are being sold at a point in time, so stop your over revenue recognition, says the ISB. And I'm, you know, I can tell you guys are not very positive about this, but I think I am. I'm not sold that IFRS 15 is perfect, but I've got a bit of respect for those criteria there. I think they're working for me. Do you want to try and rephrase your question, Nainash? I won't read it out because I'm not quite sure what you're asking me there. Just having a look at your chat there, guys. It's a very important subject. I can see that you're feeling contented about that. I'm going to use that symbol that I always use when I've come to the end of something. Here's the symbol. We've finished. And we finished the most important subject for this evening. We can relax into the rest of the evening. Let's do it. So how are we doing for time? We're halfway through our evening. 1934, I'm looking down at the computer here. I think I've got a clock up there, but rather annoyingly, I've got a bright light right in front of it, so I can't see it. But down here on my right-hand side, I also have a clock, and it tells me we're halfway through the evening, which is just perfect. Great. Let's do it, guys, then. Let's do the next subject. So the next subject is a nice little diddler called Held for Sale. It really is an absolute diddler called Held for Sale. Oops. Held for Sale. HFS. And I think it works rather cutely as a bit of alphabet soup. Do you know, I think the aircon's gone off. Can I just see if I can stretch my head around the corner there? Just taking my shoes off. I don't think you can hear the shoes being a bit squeaky. According to this, it's on. I'm really overheating. Maybe it's just me getting overexcited about Bengali tigers. Held for Sale looks really nice as an alphabet soup. See what you think of this. Cute, eh? That's it. That's the subject of held for sale. NCA HFS moves to CA. What does HFS mean? Of course, that's held for sale. What's NCA? Non-current assets. So by implication, CA is current assets. Imagine you have some plant that is held for sale up there in non-current assets. Held for sale. In non-current assets, of course, the plant that is held for sale is held for sale. So it's a current asset. So if you have a current asset, the current asset should move into current assets. And that's the idea. So that's all there is to it. If you have a non-current asset that's actually a current asset, then move it. But the ISB, they wasted so much time on this nonsense in the years 2000, 2001, 2003. They came up with some scientific criteria to test NCA HFS. So there are criteria that apply to this, and we learn the criteria. It's very naff, but here it is. An NCA held for sale qualifies as held for sale if it fulfills all 4 criteria of sale. So we must fulfill all the criteria of SALE. S is sell. A is available. L is locate, and E is expected. And each of these has a meaning, and of course I'm going to give you the meaning of that. S, sell, is directors have an intent to sell at the year end. Available is the asset is ready to go at the year end. Locate is a bit of a strange one. Locate is the phrase that's used in the IFRS, but there's a better L, which is looking. If we're looking for a buyer, then we fulfill the locate criteria, which is fully phrased as we must be actively seeking to locate a potential purchaser at the point of the measurement. In other words, we must be looking for a buyer. Expected is okay. Sale. Expected. Within 12 months. If you have plant up in NCA that you suspect is HFS, then you test it with the sale criteria. If you fulfill all criteria, 1, 2, 3, 4, then the NCA is HFS, so you move the plant out of NCA into CA. However, if you fail just one criteria, then the asset is not HFS, so it stays still. And that's it. Either the asset moves or it stays still. Either it moves or it stays still. It stays still or it moves. That's it. You fulfill all criteria, it moves. You fail one criteria, it stays still. It's, I know, I'm not saying it's bad financial reporting. The reason I get exasperated about this, I'll tell you the reason I get exasperated about this, is because the International Accounting Standards Board spent years developing those mindlessly detailed IFRS criteria at the very point that IS 39 was complete rubbish. Then IS 39 contributed to the chaos of the 2008 financial crash. And instead of concentrating on financial instrument accounting in 2004 and 2003, they were noodling around with this. So that's what drives me mad about this, which is probably slightly too political, and I really probably care a bit much. But, you know, okay, it's all right, it's criteria. It comes up regularly. How many marks? 1, 3, that sort of thing. It can be in the A section, but very, very rarely. It's almost always in the B section, where there's the classic. I just invented this little mnemonic which seems to be working for me, and we'll be using this in revision. It's the ACCA model, where you go knowledge, application, knowledge, application, knowledge, application. And what you do is you just whack down the SAIL criteria, the knowledge, and then you apply it to the story. And I have to be honest with you, almost always in the examination, it's almost always that one of the criteria is failed. So you identify the criteria that's failed, say it's failed, and say that the plant stays still. And that's how it works. So it's knowledge, application, 1 mark each, and therefore, you know, HFS tends to be 2 marks. Okay. Closely related to HFS, but different, it's in the same IFRS, but different, is the concept of discontinued operation. Oh, there you go. Discontinued. An operation is classified as discontinued if one of these apply. And I quite like it as a shopping list, although I might be slightly overcooking it. The operation is closed during the year. The operation is sold during the year, or the operation is HFS at the year end. And of course, to test if an operation is HFS at the year end, we use the SAIL criteria. What is the effect if you have a discontinued operation? The effect is quite profound, actually. It's quite a big effect. The discontinued operation is slotted into just one line on P&L and one line on balance sheet. If the sub is considered to, it's usually a sub, if the sub is considered to be discontinued, it is non-consolidated and it goes into the P&L like this. And I can teach you a bit of extra corporate reporting here, a little bit of extra performance reporting before I get into discontinued. So a P&L goes operating, super exceptionals, financing, and tax. That's the basic idea of how a P&L goes. But what you do is you have a separate line for the discontinued operation. And you know what accountants are like? We're romantic people. When we don't have any numbers, we give it a kiss. And what I think I'll do is I'll stick with discontinued now. Now, let me draw up a timeline for you. So the year starts over here and the year ends over there. And at the start of the year, we have a coffee subsidiary. Okay, we've got a coffee subsidiary. Our main line of business is to build computers. At the beginning of the year, we build computers. At the end of the year, we build computers. We build computers continuously through the year. We were building computers last year. We're going to build computers next year. Computers is our continuing business. And coffee we were doing last year, and we do it up to the halfway point of the year. Okay, we do it to the halfway point of the year, and then we close the coffee business. But the coffee business lived for half a year, and during that half a year, it made some sales, and it had some costs. And the difference between sales and costs is called profit. And if you have sales and all the costs including tax, the profit is called profit after tax. And the figure that you stick in as discontinued is the profit after tax for the 6 months from the start of the year up to the point that you sold or closed the sub, the coffee sub. And the reason you've called this operation discontinued is you've stopped serving coffee to the people. You've discontinued, you've stopped serving coffee to the people. Actually, it's tea, but it's in a coffee mug. Now, this is, and I'm really going for this. I'm not quite sure why I'm going for this quite so much. Well, I do know because I've been asked a few questions about it today. But if you, this is, there's my year. Go back to coffee. Actually, we're selling coffee at the beginning of the year and we're selling coffee at the end of the year. Our core business is computers, and that's definitely continuing throughout. But coffee, we intend to get rid of the coffee, but we haven't got rid of it yet. In which case, we test the coffee to see if the coffee operation is held for sale. If we fulfill S, A, L, and E for the coffee operation at the year end, then the coffee operation is considered HFS at the year end. If the coffee operation is HFS at the year end, then the coffee operation is also considered to be discontinued. What do you call plant that is held for sale? You call it plant held for sale. And what do? You put it into current assets. What do you call property that is held for sale? It's property held for sale. And what do? You put it into current assets. But what you call a coffee operation that is held for sale. You call the coffee operation that is held for sale discontinued with a D on the end, which sounds like a bit of a lie because actually it's not discontinued yet. It is going to be discontinued in the future, but it's not discontinued yet. But you do call it discontinued because that's the law. And what you do with the profit after tax over the whole 12 months, you stick it down the bottom there. What do you do with the profit after tax over the whole 12 months, the answer is you stick it down the bottom there, in there. But of course the operation is still existent at the year end, and balance sheets are at the year end. What you do is you crush all the sub-assets and all the sub-liabilities into one figure, and you slot it in on one line so you don't pollute the continuing business. Let me show you that on the balance sheet. So it's NCA, CA, discontinued. And again, as accountants, we're romantic people. We use kisses when we don't have numbers. There we go. There we go. Now, the reason we do this is we believe that we are talking to shareholders who really don't want to know about the discontinued operation. And so it looks almost like we're highlighting it, doesn't it? But actually we're doing the opposite. We're pulling all the sales out of the continuing sales because we're not going to continue to sell in coffee anymore. We're slotting the discontinued operation into one point because soon that thing will be exiting the balance sheet. We're just sticking it in here and there in order that we have minimal effect of the discontinued operation upon the balance sheet and the P&L. And the reason is because we believe we're talking to shareholders who are interested in our continuing business, which is our computers. Okay, so we're going to talk to them about this using the management commentary, tell them all about our plans for the computers, tell them about our plans to sell the subsidiary that's doing coffee. We tell them about the plans to sell the coffee subsidiary. We tell them about the future of computers in the management commentary, and then we have FS that reflect that in the back of the annual report, where the coffee element is slotted in here so that the shareholders can imagine what the group would be like if we pulled it out. Okay, so it's just slotted in here. Now, we're not trying to keep these figures secret. In the notes, there'll be loads of information about, you know, the profit after tax and the net assets. But on the face of the P&L and balance sheet, we just slot the discontinued in so that the shareholders can imagine what life will be like without the discontinued sub. Lovely, fantastic. That's the story with held for sale and discontinued. And why do we do this? We do this because we believe it is useful to shareholders. And almost certainly discontinued and what we do with discontinued is useful to shareholders. But what we do with non-current assets, you know, it's highly dubious whether the shareholders really care whether the plant is held for sale or not. But there's a question here that I want to address that's related to that, which is what are the disadvantages if NCA held for sale fails the 4 criteria and stays at NCA? The answer is essentially there are no disadvantages to, you know, to staying in NCA, and there's no advantage to moving to CA. If plant is held for sale, then it is held for sale. It should go into current assets, I guess, but there's no advantage to it. There's no advantage or disadvantage to being in one place or another. It's just that, you know, if plant is held for sale, it should be in current assets, and if it's not held for sale, it shouldn't be. That's all that is. So there's no advantage or disadvantage here. But can I just point one thing out to you, which is very common. These two do touch, but they are separate concepts. Non-current assets held for sale are assets. It is very common for students to have some plant and they call it discontinued. No, it's operations that are discontinued and plant is held for sale. And it's the same but the other way, but not quite as common, is when you have an operation, the operation, they call the operation held for sale, and they get the two of them mixed up. Actually, I don't want to take this any further. They get the two of them mixed up. So try and remember that to be a non-current asset held for sale, you have to be an asset, and to be a discontinued operation, you have to be an operation. Okay, so if in the story you have an operation, then test the operation for discontinued. If in the story you have an asset, then test the asset for held for sale. As you can see from what I've said up there, there is slightly more subtlety to this than I've just described there, but that's a good guide, because it's really common for students to get really mixed up and just make a horrible mess of these two. So I'll just say that again because it is such an important point. If you have an operation in your story, then test the operation for discontinued. If you have an asset in your story, then test the asset for held for sale. Okay? Cool. Just see if we've got any more questions down there. No, everything's good. Great. Fantastic. And we've got half an hour to go, which is perfect. So, over the page, we've got segments. Segmental reporting involves splitting performance and position into between performance and position between divisions. And the basic idea is encapsulated in the little baby question, Kipling. It is a baby question, but it is the one that I want to do. So on page 112, let's do it together. So there's a little baby question called Kipling, which will give you the idea. I'm just going to start fresh, new, brand new page down here. So question, Kipling. There we go. So Kipling is an education provider in the UK and the US. The figures split out as follows. And as you can see, there's a split between professional and higher education and US and UK, which means that we need two forms of segmental reporting. One of them is called product and the other one is called geographic. Product. So the product segmental report splits the total between professional and higher. It's revenue, operating profit, and net assets. Which is 700, 200, 500. And we're going to split it. Oh, sorry. Can you see? I feel like bringing up the notes in front of you so you can see what I'm working on. So here we go. Still down at the bottom there, so I'm just going to come to the top of this chapter, to page 112. Here we go. So here's the question, Kipling. You can see that my segmental note is going to be split between professional and higher, and you can see I'm going to use 50% and 50% to split the revenue and then work my way down. So here I go. So it's 350, 350. Next one is 3070, so 60, 140. Next one is 500, so that's 150 and 350. And that's it. That's how segmental reporting is done. Now we do the geographic segmental split.
over to you for a second. See if you can populate that little table, and then we'll have a chat about it. Yep, we copy out the totals. There you go. Actually, if segmental reporting is waiting for you guys in December 2015, it'll be either one or the other. This guy over my shoulder is what's called a multinational conglomerate, as the technical name. Multinational means multiple nations, and conglomerate means multiple products. But you won't have a multinational multi-product. You will have either one or the other. But you know, it's just nice reinforcement to have one that has multiple products in multiple countries. You can see, you know, segmental reporting twice, and you can see that it's not a particular. It is a multinational conglomerate, but it is not an enormously complicated one. The truth of the matter is that what the examiner examines here is over my shoulder. You know, the numbers, which, as you can see, are simple. But he also examines a complex little thing. Which I'm going to look at very briefly. It's studied, by the way, in the notes on page 113 and 114. So this is all in your notes already. But what I'll do is I'll reinforce your notes by talking you through this rather tricky subject. You'll be surprised to hear what the problem is. The problem in segmental reporting is these two babies here, which is not obvious at all, is it? It's what to put at the top of the columns. That's the problem. Well, surely not in this case. No, you're absolutely right. There's no problem here. Obviously, if we operate in the US and the UK, we just use those two words and we're sorted. But what if you operate in 200 countries all around the globe? You know, what if you operate in 150 countries all around the globe? You can't have 150 columns. You know, Starbucks is operating in whatever it is, 180 countries all around the globe. And therefore, as a consequence of which, Starbucks has the potential to have 180 columns, but that would be insane. And the solution to the problem is called aggregation, but more particularly, it's called reportable segments. But it means the same thing. Aggregation, adding together to give you reportable segments. I'll give it you the official name, which is reportable segments. And I'll phrase it like that. The difficulty in segmental reporting is the aggregation of segments in big businesses. Big businesses. Have I said that right? Businesses. Businesses. Gosh, I don't even know. Big businesses. The overriding concept is usefulness. And this simple concept, because it is so simple, is easy to forget. It's easy to use and it's easy to forget. And there's an example that we'll be looking at on the revision course where there are 3 segments, 2 of which look quite similar, but when you look at them in detail, they look quite similar at first glance, but when you look at them in detail, you can see that actually they're quite different. They're quite different. It's its verge again. One of the segments is railway construction, and that's obviously very different. But the other 2 segments are quite similar. They're both train operations,
But the two train operations are really very different. One of them is working with a local authority in a highly regulated environment, and the other one's working in an unregulated environment. And the two segments are really, they're really quite different. And besides, there's only 3 columns that is required if you show all 3 segments. So how many columns should you have in your segment report? 3. Why is that? Because it's useful. So the way the examiner examined his own question was he just said, come on, there's only 3 segments. It would be useful for shareholders to be able to see all 3 in columns, so do that. The examiner said in his own question, come on, it's useful to have 3 columns in the segmental report, so do that. So you can just use the usefulness concept and answer most questions, but not all of them. Some of them require a little bit extra guidance, and those 2 pieces of guidance are what I'm going to do now. They're called the 10% guideline and the 25% guideline. The overriding concept is usefulness, comma, but there is further guidance. It's the 10%, don't know why I'm squeezing up there, it's the 10% guideline and the 25% guideline. The 10% guideline is quite easy. Any segment over 10% of the whole should have its own column. What do you mean over 10%? 10% of what? Easy, Tiger. It's only a guideline. So 10% of anything, it doesn't matter. The examiner typically goes for 10% of revenue, but you could go for 10% of profit, 10% of assets, or even 10% of the employees. Any business that's over 10% of the whole business probably should have its own column in the segmental report. But it's only a guideline, so you could have, an 11% subsidiary that is aggregated, or you could have a 5% subsidiary that you think is useful to have its own separate column, and so you do so. So it's not black and white. But probably any business that's over 10% of the whole should have its own column. That's the easy one. The hard one is this one, which is properly phrased as the 75% guideline. At least 75% of the whole business must be separately reported. Oh, that is really tricky. And it's much better expressed as a 25% guideline. So I'll retranslate it. I'll translate it by saying, this means that. This means that at most 25% of the whole business must, at least 25, this means at most 25% of the whole business may go under other. And the reason I was getting mixed up there was because I was thinking ahead. And what I was thinking ahead to is a little example. How about this? You've got US, UK, but you also work in Egypt, Algeria and Morocco. Egypt, Algeria and Morocco. And what you do is you call Egypt, Algeria and Morocco other. And when you add them together, the other gives you 26%. Can you put 26% under other? No, you can't. That would be daft. And also it breaks the 25% criteria over my shoulder. So what you could do is you could pull Egypt out and still have other for Morocco and Algeria. But that is also very, very silly. The obvious solution to the problem of you've got 26% under other with Egypt and Algeria and Morocco, the obvious solution is just call it North Africa. The easiest way of making sure that you're always lower than 25% is always have 0% of other. If you just don't use the word other, you just use a better word, then you'll have 0% of other and you'll automatically fulfill the criteria. And that's the examiner's usual solution. And it's what happens in real life. The way to avoid having too much in other is don't use other at all. The way to avoid having more than 25% in other is have 0% other. Just don't use the word, and then you're automatically fulfilling that rule. There we go. That's the end of this section. It's the end of performance reporting and brings us therefore to provisions. Now if you turn over the page, you'll notice that the chapter title is Provisions and Other Standards. And you've probably guessed what my plan is for tonight. I'm going to do provisions now, and I'll do the others next time I see you. So I'll bring up the title. There's the philosophy and the disclosure and the aggregation stuff that I was telling you about. Oh, I've gone a bit far. And there we go, provisions and other standards. Provisions tonight, other standards next time I see you. And here we go with provisions. There's a criteria for provisions. It's rather cute. I think you'll like it. It's spot the rot. In order to be permitted to make a provision, you need to spot the rot. You need an R, you need an O, and you need a T. And it's a bit like the sale criteria. All three must be fulfilled for rot, and all four must be fulfilled for the sale criteria. There must be R, a reasonably reliable estimate. There must be O, an obligation, and there must be T, transfer. A reasonably reliable estimate just means, a reasonable guess. Obligation can either be a legal or a constructive obligation. A constructive obligation, I haven't done that very well actually, can I just highlight that again? A legal obligation is an obligation you have because of the law. A constructive obligation is an obligation that you have because of what you said you're going to do. So, for example, I have told my wife that I am going to go to the City of London and have pizza with her and my son on Sunday. I have promised her that, so I have a constructive obligation. It's no legal obligation because she can't sue me if I don't go, but she would be deeply disappointed, and I consider myself to have a constructive obligation. So that's the idea there. It's not very often examined actually at P2. It's nearly always a legal obligation, but that's what a constructive obligation is, an obligation that you have because of what you said you're going to do. And transfer is a really horrible one. Cash must be expected to transfer out in the future. Frankly, it always is. So it's as a probable outflow. Let's just leave it at that. Now, there's a little baby question on this subject called Russian chemical spill. And, it's recorded to the interactive product within the library, and you can have a look at it if you want to. But actually, your main homework for this week goes back to the previous session. You recall that we spent a little bit of time on held for sale and discontinued operations. And I went into some detail on that, and that's because I haven't seen that much of it recently, and maybe that means it's being saved for you in December. If it is being saved for you in December, then the homework question that I set now will be enormously useful for you. It's the double header of Rockby. I might actually bring it up on the screen so it's over my shoulder, but if you go back to the previous session, you'll see a question called Rockby, and that's the one that I want you to do as your homework. It's actually two versions of it. I'll bring it up here. There's two versions of it, because it's a really detailed question all the way back from when this was, examined in great detail. It's still examined frequently, but not quite so much detail, but this is a really good way of getting into it. Just want to change the scale. Where's my scale? There we go. So it's Rockby held for sale as your homework, but your real homework is Rockby discontinued. It's particularly the second one that I'm keen on, so I'll just double loop that one. It's particularly Rockby discontinued that I'm recommending. So Rockby discontinued, that's your main homework for this weekend, based on what we've done tonight. But speaking about tonight, what we're going to end with tonight is the lovely question. Here it is. Oil rig. Let's go into oil rig. Oops. Provisions. Question. Oil rig. Let's have a look at the story. I'll bring it up maybe. Here it is. Come in again. There we go. A company starts using an oil rig at a cost as follows. So we have 200 and we have 100. The oil starts pumping at the year start. At this point, the company sign a license with the government agreeing to dismantle the rig when the oil runs out, which is estimated to be 20 years. The cost of dismantling the rig is 120. And we are at an advantage because it does tell us at the top of the page that the subject matter is provisions. And we're also hinted that we need to spot the rot. But which of these three figures do we need to consider? Nope, not the 200, that's flowed. Not the 100, that's flowed. It's the 120. We're going to test the 120 to see if we spot the rot. Reasonably reliable estimate. There must be a reasonably reliable estimate of the dismantling costs before a provision is allowed. But clearly there is. The 120 is that estimate. The 120 million is that estimate. One mark. Oh. Obligation. There must be a legal or constructive obligation to pull down the rig. And again, there is. The license gives us a legal obligation. T, transfer
the original version of this is a bit of a mouthful. There must be a probable transfer of economic benefit outside of the entity as a result of the past obliging events. In other words, it must be probable that cash will flow out. There must be a probable outflow sometime in the future, and of course cash will flow out when we pull down the oil rig. Of course cash will flow out when we pull down the oil rig. The suppliers are hardly likely to do it for free, are they? Which brings us to the conclusion, which is the oil company must provide. But it also brings us to a problem as well. You see, the thing is about the figure of 120 is when it flows, and it's a when, not an if. When the 120 flows, it'll be 20 years from now. There's a great deal of time value of money in the future-ness of this 120 million. And it gives us a problem called measurement. It's a measurement problem. But DCF is required to accommodate the time value of money. And therefore the liability, let's give myself a little less space there, the liability must be valued using basic time value of money discounting, which is 120 million divided by 1.1 to the power of 20. Now, let's do it in this order. The power of 20 is because of the 20 years, and the 1.1 is actually 1.10. It's because of the 10% in the story. And the answer to that is it's approximately 18 million. Bash it out on your calculator to make yourself content. But there's a couple of things that I'm teaching you here. First of all, I'm teaching you the answer to the question, but I'm also teaching you the way to answer the question. Now, there are three forms of communication that you use in the B section. Essentially one in question 4 that we did yesterday. But when you're in question 2 or 3, in the mixed questions, there are 3 modes of communication. Essentially, it's heading, sentence, sentence, heading, sentence, sentence, heading, sentence, sentence, and heading, sentence, numbers. There's heading, sentence, numbers. Can you see it over my shoulder? The one just above, transfer, and indeed the one above that, obligation, and indeed the one above that, reasonably reliable estimate. They're just heading, sentence, sentence. And that is one mode of communication. But another mode of communication is heading, sentence, numbers. And the other mode is heading, sentence, journal. Recognition. The liability is recognized as follows. So we're going to debit something and credit something else. Of course, we're going to credit the creditor. in order to create the provision of 18. But I wonder what we debit. The answer is rather cute. It's PPE. The reason is this 18 dismantling cost is a cost, but it's the dismantling of an oil rig, and the oil rig is going to be used for 20 years. So what we want is we want a bit of the 18 in the first year, a bit in the second, a bit in the third, a bit in the fourth. In other words, we want to depreciate the 18 over the 20 years. But in order to achieve depreciation, you first of all have to do capitalisation. Oh, but wait a second, that 18 will be slapped on top of the pre-recorded 300 PPE. This 18 million goes on top of the pre-recorded. $300 million. Did I say that right? Was it 300 million? Yeah, 300 million. As follows. And we're using the other style of communication, heading sentence numbers now. Like so. Oh, but wait a second, then that PPE needs depreciating. Whoa, this is quite a long answer. Exactly, that's why it's 7 marks. Depreciation. Then this is depreciated over 20 years. Wait a second, Martin. Naughty boy. The question says, discuss FS effects for the current year. Oh, discuss I'm doing, because I'm doing heading sentence, sentence, heading sentence, sentence, heading sentence, journal, heading sentence, numbers, heading sentence, sentence. It's all heading sentence, heading sentence. I'm discussing, but wait a second, it says discuss the FS effects for the current year. The examiner doesn't want to know about the 20 years. He wants to know about this year. So, this year's journal looks like this. So this year's journal looks like this. Debit, credit. I'm going to make the PPE go down by 318 divided by 20 years. And fortunately, I've done this question before, so I know the numbers. So it's 15.9. And this, of course, is the depreciation of an oil rig. And what we do in our business is oil. So this is an operating cost. Going into the P&L as an operating cost in the P&L and the balance sheet. Oh, but wait a second. There were 2 18s in our question. The first 18 is up here. It's up here. And that 18 is depreciated. But the other 18 is here. And that 18 is the provision. It represents the obligation to pay 120 million in 20 years' time. But of course, at the start of the first year, the 0 point, it's got a figure of 18, and it needs to grow and grow and grow until it gets to the figure of 120, and then that's what we'll pay at the end. We'll pay off the liability when we get to the end. So the closer you get to the actual payment of 120 million, the more that the liability feels like 120 million. So that liability is going to grow over time. And the growth of a liability over time, as time progresses, is called unwinding. What? Unwinding. Quite separately, the liability unwinds over 20 years. Naughty Martin, we're not being asked about the 20 years, we're being asked about the current year. The current year journal is as follows. So we're going to have a debit and a credit. We want the creditor to get bigger as time passes and we get closer and closer to the actual payment of our liability. Our real liability is 120, and as we get closer and closer to it, the feel of the liability grows and grows. And what we did was we discounted it at 10%. We discounted it down to 18, so we unwind at the same rate that we did discount, giving us 1.8. And this 1.8 is a cost in the P&L. And it's not quite the same as interest, but it's very similar, isn't it? You can see it's using a percentage rate, and therefore it goes into financing cost. The name for this cost, by the way, is it's called the unwinding cost. It is the opposite, going through time in the opposite direction. As the balance gets smaller, that's called discounting. As it unwinds back up again, it's called unwinding. But that brings me to this, the unwinding table, which will form, a centre point for our studies for the remainder of that, our learning. It's starting again on next Thursday. This looks like this over 20 years. And you'll recognise it instantly. Years, opening, interest, instalment, closing. In year 1, we recognise a liability of 18, and then the interest accrues at 10%, which is 1.8. And then we pay the suppliers of dismantling 0, and the liability grows to 19.8. Have I done that right? Yep. And then in year 2, we start with 19.8, and we have 1.98. And we pay the engineers nothing to pull down the oil rig. Obviously, we don't want to pull down the oil rig at the end of year 2, so it accumulates again, 21.78. Then we've got 3, 21.78, and 21.78 gives 2.178, and you can see how the interest is growing and growing and growing, and that process is called unwinding. It's also called compounding, it's also called exponential behaviour, but in financial reporting it's called unwinding. No, I'm not really going to make you go all the way to the 20th year, but if you did go to the 20th year, what you'd have at the end would be 120 million, roughly, of course, there'd be a rounding error. You'd have 120 million, and then you pay off the 120 million, you owe nothing. So the liability grows and grows and grows over the period, and that is called unwinding. But there's also something else that I'm teaching. I'm teaching the answer to the question, but I'm also teaching you how to answer the mixed questions. The exam is made up of the number bashing in question 1, the narrative content in question 4, which you look at the question value for, and then for question 2 and 3, they're all little mini scenarios like this. They're a mix of this and a mix of that and a mix of the other. What sort of stuff do they have in there? They have provisions like this, and this is the way to answer. Heading sentence sentence, heading sentence numbers, heading sentence journal. And that way of answering is reinforced in the question Rockby. So the reason that I want you to look in the library at Rockby is partly so that you can reinforce your learning on
held for sale, but also so that you can reinforce your learning in the way to communicate. Fantastic, guys. Thank you very much for your patience over the last 2 hours, which has certainly been intense. I'm just slightly over, not too bad for me. Sophia will be waiting for me just outside there. Soon this building will be locked, so I better show you some slides. This one, you know the one. So I'm still mini-me in the corner, at least I think I am. I can't check on the computer, but there's a little mini-me there. So we've now done performance reporting and provisions. You're not actually ready to do the question outrageous yet. I'll show you that question when we see each other next. We have finished provisions. We have finished the subject of provisions, but we haven't finished the chapter on the other standards. We're going to do contingencies and events after the reporting period and related party disclosure next time I see you next Thursday. It doesn't take long, but I don't want to rush them because they do come up quite frequently. So we're going to do those three next time I see you. The next page tells us we should now be able to discuss revenue and discontinue. Yep, we can certainly do that. And discount and unwind a provision. Absolutely true. And next time I see you, the technical level jumps up a little bit again. We do non-current assets and leases. And of course, we finish off the other standards in Chapter 7. So we finish off Chapter 7, do Chapter 8 and 9. That's next Thursday. I wish you a wonderful weekend. Thank you for the patience over the last 2 hours. Enjoy your weekend.